Hello, Sector Watchers. Welcome to the 8th episode of Sector Spotlight on Tuesday, the 19th of November. This is your weekly update on sector rotation and anything remotely connected to sectors' relative strength and or rotational analysis. My name is Julius de Kempenaer and I'm your host for today's show. As usual, with me are Zach and Rachel for technology, but above all, mental and moral support. This show is live and interactive, so do not hesitate to participate in the online chat. If you're too shy or prefer other ways of communication, email and social media are open 24/7. And there is my screen. Ladies and gentlemen, this is Sector Spotlight. What are we going to do today? As usual, we will go over sectors, what has happened, and what can we say for the next couple of days. And then I want to spend a little bit of time on a different RRG that shows you the relationship between growth and value and the various size indexes. As usual, we have a short break, followed by questions. If you have any, don't be shy, otherwise I have to make up my own questions. Don't worry, I've got at least one. And then I want to introduce something new, because before we started Sector Spotlight, I asked a lot of people, what do you want from me? I wrote a blog article. I got a ton of response on that. And one of the frequently mentioned items was ideas or trade ideas, charts. And then, we thought about it. And then, in Market Watchers Live, we had Tom doing the 10 in 10. And now we have Tom doing 3 you must see, and Dave Keller is doing 3 and 3, and I just don't want to copy all that. And I had to think a little bit about, what can we do to set ourselves apart? And I think that the one thing that sets RRG apart is that you can see the whole picture in one picture, and you can actually see the long and short side of things. And I thought that pair trade ideas, coming up with a pair trade idea, that is what suits RRG very well, because you can see, potential longs and potential shorts. And for those of you who were in the show last week, we talked about John Deere, and I promised a picture of my tractor, and here it is. So there you go. And actually, believe it or not, that PTI, that pair trade idea, came when I was actually working on my tractor, because it clears the mind. You can do some other stuff, and it's just good fun. Anyway, let's start with what have we seen this week in the sector country. Last 5 days of performance, the classical defensive stuff has been doing actually very, very well. Real estate, utilities, healthcare, staples, services. So we had a sort of risk-off week for the market. And we have energy, materials, financials, like the stuff that we've been calling up for the last couple of weeks, not doing too well. Luckily enough, we can still look at that because this is just 5 days of performance. It doesn't say a lot about the trend that's going on. So if we bring up the S&P 500 sectors, then the weekly trends are still in play. They haven't changed too much. Be careful, the little hooks that we see here. The previous to last observation is last Friday, and the last one is about yesterday and what we had today. So that is a fluid thing, so I'm always a little bit careful on looking at that. If you look at the daily version of that graph, you will see visualized what we just saw in a tabular form on the perf chart. That is that the defensive stuff went up and the sort of conservative stuff went down. I want to stick with the weekly charts here and a few that stand out. I think that it's almost getting boring, but this technology sector is really, it's now the highest value on the RS ratio axis. So if you take that as a measure or a ranking system, then technology is once again the strongest sector in the S&P 500. But above all, it has rotated from weakening back into leading, and that is a strong sign. That's a strong signal. So technology has started a new up leg in its relative uptrend that's already underway for quite some time. So we look at the chart on the right, we see the relative strength of XLK versus SPY. That is a very nice uptrend. And the reason why we rotated through weakening here, we saw that happened since, when was that? Here, June. So since June, went up a little bit, went down again, and then last week, November 11, we came back. So June to here, this is where it moves into weakening, and now we just got back. So a couple of months of sideways movement, both in price and in relative, and we now have broken above its previous high in price as well as in relative strength, and the RRG lines are now both back above 100, pushing XLK into the leading quadrant at a strong heading. So again, it's going to get boring, but it works very well. Technology is still a sector that you absolutely should not ignore. Financials and industrials, the hooks that we see here, maybe we got to be a little bit careful, but I still do like the charts of both financials and industrials. Those breaks are still very, very valid, not a problem at all. And if we go to XLI, we see the same picture, very nice clear break, and we're holding up. Maybe it's just this, sort of stabilization after the break. But again, nothing major is going on until we seriously break back below that breakout level. But before that happens, I think we should have pretty good cues about that. On the weaker side, the sector that started deteriorating pretty rapidly, and please note the extending distances, the increasing distances between the observations for consumer discretionary. This one here, and you see that it went in, did a few weeks of recovery, but very short distances, and then started to shoot down into the lagging quadrant at a negative angle. Maybe not what you would expect, given the fact that discretionary is like seen as a offensive sector, a sector that should do well when the market is doing well. Well, maybe not this time, especially if you look at the relative strength line here that's broken out of this consolidation pattern to the downside very, very convincingly. Relative strength, RRG lines now both below 100, pushing discretionary into the lagging quadrant. So be very careful with that one. And let me bring up the beta. Rachel, I heard you. It's beta. I was told that I shouldn't say beta, but beta. So I'm doing that. And there we see that the traditional belief that discretionary is one of the top performing sectors in market rallies maybe is debatable, because it's just above 1 with its beta against over the last 12 months. And I think that's what you see right here. Anyway, enough for sectors. I think that the rotation that we've been talking about is still ongoing. I don't see any reason to change that offensive rotational view. So right now I want to jump in to another way of looking at the US market, actually. And that's a predefined, there's a couple of predefined groups that you can find inside the drop-down box, all the way down here. And the first one that I want to look at is growth versus value. That is the US stock universe, as we all know it, but now not separated into the various sectors, but into value and growth stocks. And again, traditionally, if markets do well, growth stocks are expected to do even better than the market, or they do better than value. And value is more of a defensive play. Now, what we've seen, if we scroll back this rotation over time, let me max this so we can continue to see it. We had this growth really picking up at the start of 2019 here. That is March, February, March, we started to rotate. And we held on that pattern for all these months. And you see here, you see that growth rotates back up from weakening, starting its second or third leg of the relative uptrend versus, and we're using the Dow Jones US market index here. That's the whole US market, which is separated into those groups, so it's a closed universe. Growth continues well, rotates back again. So we had this situation where we went, well, we're into weakening, and now we're hooking back up before we can have that cross where value overtakes growth. So the last last week actually, growth started to hook back up and value started to hook back down. And if we look at the daily version of that chart, we will see the prelude of that move in a little bit more detail. You see here, growth is on the right-hand side, value is on the left. And then this is November 1st. You can see that in the banner below the chart. Growth started to improve and starts to accelerate. And here we go again. And now, boom, go into the leading quadrant. Basically supporting or maybe leading the weekly rotation in favor of growth. So from this perspective, I think we can say that markets are still doing well. Usually when growth does well, markets do well. Another group that I like to look at is the separation in what I call size. And size like in large cap, mid cap, and small cap. And we can do a similar RRG. We still use the same benchmark, the Dow Jones US index. And if we max that out here, we have large cap here on the right-hand side. We got mid cap here, and we got small cap there. And again, we can play that rotation. And we see that the favor is with small caps. With large caps, with the LSL, US large caps. The narrative for a bull market would be that small caps are outperforming. That is not the case. That's not the case for quite some time. We had a situation here when they started. That was in March, and they rotated back. I thought about what would be the story behind this. Why would that be? And I came up with sort of an analogy with the fact that the rally until we broke above resistance in the S&P 500 wasn't driven by the traditional offensive high beta sectors. It was driven by utilities, real estate, staples. And it looks as if we had the same situation in the size segment where the start was driven by small caps, and then large caps are taken over. And you see that mid caps somewhere in the middle are crossing over into lagging and going to the left. And for the last, well, this is August, like 3 months already, large caps are leading the charge. And you can see how stable they are, because look, this is a 5-week trail. And on large caps, it's barely visible. That is almost stationary on its spot. You see that small caps have moved, mid caps have moved, but large caps, they've been, after this moves, that they're almost stable. So good market, led by large caps, and small caps and mid caps underperforming. Maybe you find some pockets of improvement, but for the time being, I'd say that large caps are the preferred area. Finally, the third RRG in this type of RRGs that I want to show you is the combination of both. And that's growth, value, and size. And what you see here is this list. You see US large cap, US mid cap, US small cap here. So that is the whole market that we just looked at. And then you see the value and growth split out over the various segments. So we have mid-cap value, we have small-cap value, we have large-cap value, but we also have large-cap growth, small-cap growth, and mid-cap growth. So this is basically the combination of the previous two charts all in one, with a more granular view by breaking down the value and growth segments into size as well. And again, you can play around with these. Large cap on the right hand side, still pretty good. You can see value mid-cap turning negative. This is the center of the chart, so this is the US market. We see small caps, value small caps, so value is weak and small caps is not the strongest, so this seems to be rolling over. I think this is a segment that had a good run but will not be able to make it all the way through. Here's the small caps that we just looked at. Here's values that we just looked at. Here is US large cap value, and you see again, like here was the small cap value, here's the large cap value, and we have large cap growth. So here is value, growth, and large cap was in the middle here. And then we have growth and so forth and so forth. So here is small cap growth. So if you want to play something in small caps, I think that you should go with small cap growth stocks versus small cap value stocks. They're both underperforming, but inside small cap, growth is expected to outperform value. And this is how you can play around with RRG and make up your mind based on a separation in growth versus value, and that's broken down into the various size indexes. I am going to take a look at the chat box, whatever came in. We're going to a break for like 20 seconds, I believe, and we'll be back with the questions after that. And we're back. Actually, I see two questions coming in from Dan. Rachel, do you want to help me out here?
Of course I can. Okay, Dan asks, the first question was, are you working on a tool that allows scanning for RRG results with 0 to 90 degree heading?
Good question. Ask Chip. I know it's on the list. I have a wish list of all the stuff that I would like to do with RRG on StockCharts.com, and that one is definitely on the list. I mean, this is like scanning 2.0. I think we'd be very happy if we could do some scanning based on quadrants and RS ratio and RS momentum values. Scanning on heading is like the next step. But yes, it's on the list. The list is pretty long, but hopefully, with the move into the cloud completed, with ACP on the way, I think we will get some love from the dev team, and I will push for this kind of stuff to work on.
Okay. And then the other question is, can you explain how to best use the percent change column on the right side of RRG?
That is just the performance of these tails over the period of the tail. So here it's 5 weeks. So this here is the 5-week performance for the technology sector. How do you use it? You can, for example, sort on it. That's what I like to do, because now I can see that everything above the white line here outperformed the S&P 500. Everything below underperformed the S&P 500 over this 5-week period. So green and blue is outperforming. That's cool, because that means that the stuff that's in the green in the leading quadrant and in this one is outperforming. So this one is heading there. Now, blue, red, and yellow are underperforming, which is also what we would like to see, because that confirms the position on the RRG. It's an additional tool. It's a help. It's not like something that you can steer on and take decisions on, but it gives you a better view and a picture of what's going on in the market and how these sectors have been behaving against each other. You can look at this. This is 5 weeks. If you lengthen this to 10, you can see that the order has now changed, because now it looks at the 10-week performance, which actually brings me to a question that I answered last week, and someone asked about the difference between the 5 and 25 weeks and 25 days tail. And I misunderstood that question because he was trying to match this percentage change column. And let me bring that back up because it can be confusing. So here is the weekly performance. That's 5 weeks. Now, if we bring that same RRG here, but we go to daily update and we go to 25 days here, you would expect the same performance figures as on the left-hand side because it's 5 weeks and 25 trading days. That doesn't match completely, and that was the confusing part. And the reason is that this one is day to day to day to day, and this one is week to week to week to week. Now, these dates, this says weeks ending, but I think we should change that because it's actually weeks starting. So this is the week starting November 18, and this previous week is the week starting November 11, which ended on Friday the 15th. And if we now shift this one back to the 15th, you will see that we have an exact match on the performance figures. So on the Friday of those weeks, these performance figures align. And then when we step one forward on this one here, it starts to move around. And so does it with the trading days. But now, because it's weekly and daily, we're going out of sync. But by next Friday, so Saturday morning, when you open up your RRG next to your coffee and say, hey, let's look what sectors have done this week, these columns should actually match. Anything else?
Yes, we do have one question, and that is, does the size, i.e. large cap, mid cap, small cap, represent the core stocks since you have growth and value on the chart?
The core stocks. Well, does that mean the core? I think that universe is all NYSE stocks or all listed US stocks, as far as I know.
Yes.
Not 100% sure. I can investigate that, but these indexes here, these two make up this one. So it's a Dow Jones US index. I can look it up. Let's see who does it first. I will look it up and talk about it next week. If you find it first, then cool. I think that this is a bigger group than the S&P 500. I'm pretty sure. Anyway, let's move on. Your RRG different from the one used in the final bar with Dave Keller. I have not seen that one, so I don't know which one it was, but there are many, many different RRGs. So it's very well possible that Dave used a different RRG, either in length, either in universe, whatever. So I can't answer that question right now. We have to, are there any people who, nobody comes up with pair trading because it's difficult. It's difficult to find two pairs, but RRG is going to help you. I'm going to go back to my slides here. Yeah, we've seen this one. What I try to do when I look for pair trades, the process that I go through, is I try to find the sector with high or the highest potential. The next thing I do is inside that sector find a stock with high potential or the highest potential, but that's a little bit difficult to actually figure out what the highest potential is. Then you go to the sector with the highest risk. You find the sector with the highest risk. And inside that sector, you find a stock with high risk. And then you're going to pair those two together. And then, I like to always get some sort of a confirmation from the actual charts itself. So I use the RRG to come up with the idea, to figure out the sectors and the stocks that I want to bring into the idea. And then I actually look at that pair trade on one chart. So I have identified, I already told you that I like the technology sector best right now. So it's not a surprise that we're going to look inside the technology sector for promising stocks. Now, we're not going to browse through all of them because that would take too much time. but the one that I really like is Broadcom, AVGO. And remember, we're looking for stuff that still has room to move, so that has still ample room to move to the right-hand side. Now, bring up that stock on a price chart. That looks nice. It's actually breaking out, trying to break out above its all-time high. And I would like to confirm the rotation that I see on the weekly with the one on the daily. And if you then look at, where's AVGO? Here on the daily, we're on the right-hand side, rotating there. On the weekly, we're going there. So I hope that this rotation will take place on the right-hand side. But the weekly rotation in combination with a break to new highs is what puts me on track for Broadcom as a potential leader inside the technology sector going forward. So make a mental memo of AVGO, Broadcom, as the long leg of our pair trade. Now, the sector that I don't like, and I think I can qualify as the weakest, is energy. Despite the rally here, it's so disconnected from the rest of the pack that I think that we have to treat this as a temporary rally. And we're already seeing that hook again. We have to wait until the end of the week, but I believe it's rolling over. If we look at the daily rotation for energy, that's not super strong either. It's just rotated back into the lagging quadrant here. So I'm going to pick my short side inside the energy sector. So inside energy, and here is energy. And again, I'm not going to go over all of them, but I've identified XOM, ExxonMobil. And why is that? Because look at this rotation here. It tried, didn't work, almost there, and now boom. And this is a big one inside energy, and it's starting to move inside into the lagging quadrant. And if we look at it on a daily chart, then we will, where is XOM? Come on, baby. Here is XOM. We see that it's also rotating back towards lagging. And then put it here, and we see something that is not very strong from a relative point of view. Now, finally, as the final idea here, you want to look at AVGO and put it against XOM. XOM. Here you go. Oh, oops. No. XOM, here you go. And there you see a nice break in relative. Stock breaks out. RRG lines are starting to curl back up. I think this is a very nice pair trade to actually keep an eye on for the next coming weeks. I think that you should look at that. So this is how I look at pair trades from a sector perspective and a stock perspective. I'm going to bring this back hopefully every week. And if you've got any ideas, shoot them to me. Ladies and gentlemen, this was the 8th episode of Sector Spotlight. Thank you for watching. Please don't be a stranger and stay in touch. I hope to see you back next week, same day, same time. Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com. And even better, subscribe using the link below each article to make sure that you will receive a nudge every time an article is posted.